While some online bullion dealers continue to charge $4 over spot for U.S. Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Jubin with the SD Weekly Metals and Markets wrap. Well, today we had Jackson Hole. It sure didn't disappoint as far as market volatility, Eric. Yellen started talking, and gold and silver instantly dumped, and then both actually skyrocketed. Gold was up almost $20 on, I think, 4 ticks. Silver burst from, I think it was about trading at around 1850, all the way it poked through 19, so about a 55 cent move in silver in under, I think it was about 5 minutes time. But then after Yellen came out and the market interpreted her quotes, then the Fed trotted out Fisher for the other side, and down went gold, down went silver. So what's your take here on the big Jackson Hole speech and just the crazy market gyrations in all the markets, but specifically here in gold and silver today?
Yeah, pretty interesting to see a good cop, bad cop routine in about a 2-hour window span. We don't typically see that when one of the most important speeches of the year for a Federal Reserve chairwoman to make. They typically will frame and spin and do job owning afterwards, but this is just an indication of how intense they're trying to manage market expectations. The market correctly interpreted Yellen's comments as largely, again, reflecting the overall lion's share of the voting camp that is more dovish than not, despite the bad cop routine that Stanley Fischer represents in the camp that he's speaking towards. It's actually pretty telling to look at the statement that she made with respect to the Fed's estimation of where their forward expectations are in their model. It's refreshingly kind of honest, believe it or not, because it shows that the Fed really doesn't know what the heck they're doing, and it's worthwhile actually discussing some of that, and I'll quote a portion of what she said. When it comes to the economic outlook in their model, she said, "The economic outlook is uncertain, and so monetary policy is not on a preset course. Our ability to predict how the Fed funds rate will evolve over time is quite limited because monetary policy will need to respond to whatever disturbances may buffet the economy. In addition, the level of short-term interest rates consistent with the dual mandate varies over time in response to shifts in underlying economic conditions that are often evident only in hindsight. For these reasons, the range of reasonable likely outcomes for the Federal Reserve rate is quite wide, a point illustrated by Figure 1, and they presented this handout to the press. But the range that they're talking about is a rate between 0 and 4.5% by the end of 2018. I mean, you can drive a truck through that. They really don't know what the heck they're doing, and if you look at some of the statements that they make for public consumption, it's patently obvious that that's where they stand. But how many times will a Steve Leisman on CNBC declare this is where they're going and then frame the jobs reports? And it's a circus. I mean, the reality is that they're kind of just flying by the seat of their pants and trying to maintain asset prices elevated so that we have a wealth effect and that the economy doesn't roll over and turn. And that's really their main goal, is just trying to keep all of these spinning plates up and running, and anytime they need to adjust sentiment, they just bring out a different job-owning spin from some other representative, and Stanley Fischer served as that bad cop today. And some of the things he said are interesting as well, too. He was talking about how, let me pull the quotes up here, we are not election forecasters. We look at economic signals. We are resolutely not a political body. And he was essentially trying to steer the market towards an understanding that the September meeting could in fact be a quote-unquote live meeting, and that we'd have 2 rate hikes this year. And that's
a load of crap, in my opinion. I mean,
it's totally a load of crap.
There is no chance, and there's no snowball's chance in hell that they're going to hike rates 60 days or less before the election. They hate Trump.
Yeah. I mean, Fisher outright said Yellen's comments are consistent with a possible September hike. I mean, and he's just blowing smoke. They're not going to raise interest rates in September.
So now we can look forward to all week next week. CNBC, they're going to be trotting out the September live meeting meme again, and this is the biggest jobs report of the decade, of the century, of the millennium.
Yeah. Well, it probably will be a BLS magic act as well, too, because it's the last report that they will have that can have a pretty significant setting of the tone in the debates coming for the election. So, unfortunately, if that reasoning proves to be where the political forces pressuring the BLS bureaucrats falls, then we probably will have a pretty damaging unemployment report that'll be filled with the seasonal adjustments and all of the various tricks that they do to try to spin the way those numbers are interpreted. But silver today is still positive, and it's bouncing off of this 1860 level because traders that have been, and also longer-term COMEX paper buyers that are positioning themselves to benefit from the month-plus view as opposed to these shorter-term machinations, are buying this dip. They have been aggressively buying for very many months now, going up against the interests like J.P. Morgan that are constantly issuing new short issuance to absorb all this rising demand. The fact that silver bounced today at 1860 is significant because it does show where the thinking rests in the pit, so to speak, at COMEX, and where these longer-term speculators are framing their decision matrix vis-a-vis the cartel. And it's speaking to where the longer-term sentiment is going to move going forward on the matter of the weeks forward. So I think that that's significant, and it really is hard to see given all of the commotion and noise. And the economy is continuing to demonstrate that it's falling into a rut. And we have the Federal Reserve now talking openly about doubling the size of their balance sheet to be able to purchase assets in mass the next time the stock market and other markets go down. And it's clear that they are trying to present an image of things being a lot more stable than what they really are. But if you look at what their policies are going in terms of how they're actually scrambling, trying to figure out how to address market perturbations in the future when their credibility has gone out the window, and also turning towards fiscal policy as being something that would be able to catch the economy on a going forward basis is going to be with us. So over the course of the next week, we'll probably see a little bit more downside, but this is probably going to turn, and it's just a question of when. Unfortunately, I can't really tell what's going to happen next week because the key is going to be whether or not the manipulators want to leverage this jobs report and push things down just a little bit longer. But the correction has been going on for nearly 2 months now in terms of the consolidation that's been artificially painted. And the buying is still here. The dip buyers are here. It's just that we have been pushed back further, and that's what silver is signaling right now. So it's generally still a positive picture, even though we're stuck, and it'll probably take India coming on board and buying a lot more gold in a week and a half, 2 weeks going forward as their holiday season comes, and you're finding a little bit more incremental buying on a physical basis that'll help counter all of the machinations that are going on in the COMEX.
And if that forecast on the jobs report next week comes to fruition, if we see a huge jobs report number because they're trying to make the economy look as good as possible for Hillary ahead of the debates with all the seasonal adjustments and just outright fabrication, I think, in my personal opinion, you're setting up for a huge buying opportunity, because once you have that September meeting, then I mean, next week in that jobs report, the algos are going to be start to price in rate hikes based on Fisher's comments today, and then a huge job report number. If you see that, I think that could be the time to look at adding to your positions. It could be a great opportunity as suddenly the algos shift to pricing in a rate hike in September, which frankly I don't think is going to happen in any way, shape, or form. I don't think there's a chance in hell it's going to happen. So if we're right on that, that could be a very excellent opportunity, because you're probably looking at only a week's time that then the market is suddenly surprised when the Fed doesn't hike.
Yeah, it'll turn out that way. I'm pretty confident. I mean, the longer-term picture in this bull market is up and running. We have now over $13 trillion in negative interest rates. I mean, something on the order of about half of new issuance for longer-term bonds in sovereign bond market are now negative. I mean, it's crazy what's going on. But
and I think you'd probably be looking at silver retesting the 18 level, possibly 1750, and basically that entire move from 1750 to about 2150. And I mean, gold at a minimum probably retesting 1300 if that comes to happen, and quite possibly around that 1280 level. So yeah, those are kind of the technical levels I'd be looking at.
Yeah, and that is well within the realm of possibility if we get a really ugly Friday unemployment report next week. I tend to think that we're going to see a lot more dip buying and people stepping up to the plate, and silver holding 18 and all of that. But time will tell. And unfortunately, this is the kind of thing where it's not possible to forecast this with any reasonable degree of probability, because it's strictly based on the arbitrary whims of the manipulators at the Fed and other central banks. So.
Yeah, we're sitting here purely speculating on what they're going to do, how they're going to fabricate the jobs report to manage the economy how they feel like next week. So that's what this all boils down to, sadly.
But another indication as well, too, about all of the dip buying is in the physical market, too. And the sales rate that you're experiencing is telling. Why don't you talk about what's going on at SD Bullion for the last couple of days?
Yeah, and I mean, just kind of broadening out over that, I mean, silver investors have been concerned here this summer as the U.S. Mint sales just almost completely dried up about, 6 to 8 weeks ago now. The Mint hardly sold any coins in July. Well, I guess their first week or two of July, they still were under allocation until the end of the allocation, but still only 1.3 million Silver Eagles sold in July. And month to date prior to this week, there was only 300-some thousand Silver Eagles sold. And that conflicted a little bit with what we'd seen at SD Bullion. I mean, we had all-time record sales month in July, and we're about to break that with a new all-time record sales month here in August. But as we've explained quite a few times on the show, we think a lot of that, or nearly all of that, was due to the authorized purchasers making a decision to work down some of their inventory. This week's second half of this week, the smash saw a big resumption in physical silver demand. You can see it by looking at the U.S. Mint's numbers. August sales now are 1.01 million. And I was mentioning to Eric before the show began, I think the U.S. Mint sold more Silver Eagle coins in the last 2 days than they had the entire month to date. I mean, they were at 300,000 some coins month to date going into this week, and they've sold, I think, 630,000 coins on the week, about 4 times what they'd sold per week over the last 3 or 4 weeks. And it's not just Silver Eagles. We've seen premiums on 90% jump about 20 cents in the wholesale market, which is the first time in, what's it been, Eric, about 6 or 7 months since we've seen premiums on 90% rise.
Right.
I think it's been at least that long, maybe closer to towards the end of Q3 last year, since the premiums actually rose. So, I mean, again, they're still low, but
it's the inflection point that's what's relevant. I mean, the shifts that we're seeing now, the really large shift in the buying at the Fed is interesting because for roughly about a month or so, we've been speculating that this is about the time where we would imagine that the authorized purchasers' inventories would have been drawn down a lot. And now that we are at 1850 testing, and we dipped a little bit below that, but the buying is here and the level at which you would expect the people patiently waiting to buy the dip diving in fact, is being confirmed by the Mint sales. and what you're seeing in your own desk as well, at SD Bullion. And maybe this is, in fact, confirming what we hypothesized about a month ago, or a little bit more than a month ago, and it goes back all the way to when we had the CEO of Sunshine Mint on, talking about how the authorized purchasers earlier this year went bonkers and built up an inventory because they were trying to capitalize on what they anticipated was going to be hitting a jackpot by being able to have silver going up and a large inventory, and then they worked that down. They also wanted to be able to order more in allocation, because the ability to buy a lot in allocation is predicated on previous buying patterns. And maybe that's where we are now. Maybe we'll be able to see premiums actually give us that intelligence and ability to forecast within a week, and by next week. And it'll be really interesting to see if on.
And there's actually one other data point that just in the last 48 hours has developed, and we haven't talked a lot about it on the show here. We maybe mentioned it once or twice over the summer. But the one other thing I personally believe has impacted Silver Eagle sales this summer has been just the tremendous amount of secondary 1-ounce silver rounds that have come onto the market over the past 3 months, as silver came up near $20 and broke over $20. I mean, it's unprecedented, probably in the past 10 years in this industry, the amount of secondary market product coming onto the market. I mean, the amount of secondary product, you've seen it at SD Bullion. We've been selling rounds for 49 cents over spot any quantity, I think, for 4 or 5 months now. So that just tells you the amount of secondary market, and that takes up a lot of the demand. Hey, if I could buy a Silver Eagle at $2.29 over spot from SD Bullion, or I could buy these rounds at 49 cents. There's a lot of people that might normally buy Silver Eagles that are adjusting their purchasing habits and patterns due to this huge amount, just tremendous amount of secondary silver that has come back into the market as silver broke back above $20. And we've seen that the whole summer. And that secondary silver has just about completely dried up over the past 48 hours. So that's, again, an inflection point, in my opinion, that's not just going to instantly come back into the market. Now, sure, if silver bursts back up towards $30, you might see another big burst of product coming back into the market. But if we languish here in the mid-18s, 19, there's not going to be that just massive amount of inventory in the secondary market coming to meet investment demand. All right, so we'll definitely keep an eye on these trends here. Again, we're really only a week away from the market coming back from summer vacations, getting back into the swing of things in September after Labor Day, and seasonally, September is one of the strongest months, if not the strongest months of the year for not only demand but also prices for gold and silver. I think actually September is the strongest seasonal month of the year for gold prices. In my mind, it's certainly setting up for another similar September here. In 2016.
India is probably going to be the biggest catalyst actually in the next 2 weeks, because the amount of spunkling that's been going in is pretty monumental. World Gold Council only estimates like 150 metric tons of gold being smuggled into India, and that's just preposterous. The largest refinery over there recently reported that they had to completely shut down their operations because they're just not getting enough bullion, because more of the bullion and the doré bars are going in through smuggling routes, and the smuggling in India could be as much as 400 metric tons of gold this year, and they're gonna, they're gonna be bringing in a lot of gold, and that's gonna change the tape. And the physical market is very, very tight. And that is what's going to push this market back up and prevent the manipulators from being able to push us below more key technical levels. So, and time will tell. But next week will definitely be interesting. Everybody's got to pay pretty close attention to what's going to happen with the unemployment report. The best that I can say as far as the probabilities are that we probably are not going to see a lot more downside, even if the report sucks, because the buyers are stepping up to the plate. We can see them. They're here. They're even here today in silver, like we talked about before. And the market, there's not a lot of slack, and the premiums are suggesting that as well, too. So time will tell.
And then the one final thing that'll be interesting here over the next week is the management of the dollar versus the yen. I mean, that's nearing critical levels. It's clinging right around that 100 level. I mean, if a break down below there, I mean, that would be the turning point, both probably for bonds and gold.
We almost hit 100 today, and then swinging all the way over to 1.16 plus in dollar yen is clearly an indication that the Bank of Japan is also intervening today. That's a really big move, and there's coordinated action going on among central bankers to try to keep all of these plates spinning.
I mean, it was actually gapping down while Yellen was talking.
That's right. Yeah, even the bond market was declining. Rates were falling as Yellen was trying to, present this rosy picture about the economy, and the bond market wasn't buying it. I mean, the market largely is interpreting what is being spun by the Federal Reserve and seeing through it, but we see the algo step in when the headline triggers get hit, and particularly this dollar-yen cross and how the algos track that. And then, of course, when we have the bad cop routine with Stanley Fischer, we see shorter-term periods where people freak out because they're trying to price in what the expectations are being set as far as the Federal Reserve is concerned, but the whole notion of them raising rates in September is just farcical. It's not going to happen.
All right. Well, unfortunately, the pain hasn't ended for the week here as we close the show, recording towards the end of Globex trading here, and gold and silver are still actually being pushed down to the lows of the session and just about to the lows of the week. I've got about 1321 gold and 1864 silver right now. Looks to me like they're trying to push it back to a under 1860 in silver, and I think they'd love to have a 1319 close or anything under 1320 close in the access market here in gold for the week.
Yeah, in the last hour or so, you can see high-frequency trading pushing silver down. They're managing the market. It's very clear. You can see it in the actual chart. What can you do but laugh? I mean, if nothing less, these guys are predictable, and our dear grandmother Yellen.
That they are. All right, well, we will wrap the show there for the week. Certainly, I suspect we'll have a lot to talk about in next week's show, heading into the long weekend. So, for the Doc and Eric Dubin, thanks for tuning into this week's SD Weekly Metals and Markets.